The purpose of this presentation is to discuss Apple and Samsung and their financial statements. First, we're going to talk about Apple's background. Their first iPhone was released in 2007, and they're known for iPods, iPhones, and Macs. Apple has grown into a technology giant. The company was first founded by Steve Jobs and Steve Wozniak, and their first product was the Apple I personal computer, and it was released in April 1976. The company went public in 1980, offering 4.6 million shares for $22 each. The Macintosh computer was first introduced in 1984, and to this day, recent models continue to be some of Apple's most popular products. In 2001, iTunes and the iPod were released, and the first iPhone was released in 2007. 10 years later, they have announced the 8th iPhone as well as the iPhone X. The company has grown extensively, causing the stock split of 2014, reducing prices from $647 to $92 per share. Tim Cook is the current CEO of the company, and they do not show signs of slowing down anytime soon. Next, we'll talk about the background of Samsung. Since founded in 1938, Samsung has become one of the leading global electronic companies, specializing in digital media and appliances, semiconductors, memory, and system integration. Samsung was founded in 1938 in South Korea. It started as a food exporter, then transitioned to include life insurance and textiles. The electronics sector of Samsung started in 1969, and their first black and white TV was sold in 1970. As time continued, they focused more on producing more electronics, color TVs, VCRs, tape recorders, and personal computers, and exporting more products to North America. In the 1990s, they started selling memory and hard drives for computers. Their first internet-capable cell phone was released in 1999. Their TV production has evolved, and Samsung has become a leader in HDTV production, and has also become a major competitor in terms of smartphones, tablets, and smart TVs. Both Apple and Samsung use the FIFO cost flow method. This is typical for companies producing electronics. They hope to account for the need to phase out current models to make room for the new. FIFO allows for the highest value of inventory as well as the highest amount for net income during a period of inflation. Under FIFO, this also allows for the highest amount of ending inventory and the lowest cost of goods sold.
As for research and development, in 1998, Apple CEO Steve Jobs stated, "Innovation has nothing to do with how many R&D dollars you have." Apple was once reluctant to spending in this sector, but it has since become one of their largest expenditures. In 2015, they spent a total of $8.6 billion on research and development, and that grew in 2016 to be $10.4 billion. This money goes towards research for the Apple Car, augmented reality, and healthcare communication research and development. And despite a fall in revenue in 2016, Apple has continued to increase their R&D spending over time.
Our group discussed two accounting issues of Apple. One is about a rule change in recording the revenue. Before amendment, Apple recorded sales revenue over the length of a product's life, but after the rule change in 2010, it recognizes all revenue from sales when sales occur. Before the change, the old rule helped smooth out the differences between good and bad quarters, and shareholders could feel the stability of Apple. After the change, numbers and ratios on Apple reports from 2010 would fluctuate than those past, but they'll be more accurate for each quarter. According to the Wall Street Journal, the change is beneficial for Apple, who has strong sales in a quarter. The other issue is about Apple's cash. Apple reported that it has $16 billion of cash in 2016. However, this was not cash on hand. In fact, reserves of Apple are mostly in long-term securities and overseas. Long-term securities take a big portion of cash and cash equivalents, and Apple had to pay about $178 billion, including interest for those securities over years. Overseas reserves, which take 93% of stated cash in 2016, will not be brought back to United States due to high taxes. This means Apple keeps piling up debt in the United States, and it will be hard for Apple to pay promised cash to its shareholders.
Liquidity ratios are a measure of the short-term ability of the company to pay its maturing obligations and to meet unexpected needs for cash. The first ratio, the current ratio, is used to give an idea of a company's ability to pay back its liabilities. For every dollar of Apple's current liabilities, there was $1.35 of current assets. For Samsung's every dollar of current liabilities, there is $2.59 of current assets. Samsung had a higher current ratio, which shows that the company is more capable of paying its obligations. The next ratio is the account receivable turnover, which measures the number of times on average a company collects receivables during the period. Apple's account receivables in 2016 was 7.31, while Samsung's was 7.26. This shows that the companies had a very similar account receivable turnover in 2016. The average collection period is the amount of time it takes for a business to receive payments owed in terms of accounts receivable. The inventory turnover measures the number of times average inventory was sold during the period. A high measure indicates the inventory is being sold and replenished frequently. A low turnover like Samsung means that there are weak sales due to excess in inventory. Days in inventory measure the average number of days inventory is held. Apple's days in inventory is 5.9, which is way faster than Samsung's days in inventory, which is 56.68.
Solvency is a measure of a company's ability to survive for a long period of time. Debt to assets ratios, times interest earned, and free cash flow are all solvency ratios. Debt to assets and times interest earned help long-term creditors and stockholders determine the company's ability to pay off debt, while free cash flow displays information about solvency itself and the potential to pay dividends or make investments in new projects. Debt to assets for Apple increased from 34.4% in 2015 to 60.1% in 2016. This increases the riskiness for investing in Apple as they are less able to meet their current obligations, while Samsung has a lower 2016 ratio of 28.8%, so they are more capable of withstanding losses without concerning their creditors and are less reliant on debt. As for times interest earned, in 2015, Apple had 99.3, and then in 2016 it dropped to 43.1. This is due to Apple's interest expense doubling between 2015 and 2016, causing the large difference between the 2 years. As for Samsung, in 2016 they had a times interest earned of 88.5. Lastly, for free cash flow, it determines the potential to pay dividends or make further investments. In 2015, Apple had $69 billion in free cash flow, and that dropped to $52 billion in 2016. This was the first year that they faced decreasing annual sales since iPhone's release in 2001, due to a great contribution in net cash. And then as for Samsung, in 2016 they had $22 billion in free cash flow. Apple is high margin, high profit, and this is why their free cash flow numbers differ so greatly.
I will now be talking about Apple's and Samsung's profitability ratios and how they compare. Profitability ratios measure the income or operating success of a company for a given period of time. The ratios measure the efficiency of a company to turn business activity into profits. The profit margin ratio measures the percentage of each dollar of sales that results in net income by calculating the net income divided by net sales for a period. Apple's 2016 profits margin of 21.19% is nearly double that of Samsung's 11.10%. These ratios show how Apple has an increased percentage of each dollar of sales that results in net income in comparison to Samsung. The gross profit rate shows a company's ability to hold an adequate selling price above its cost of goods sold and is a strong factor that influences the profit margin. The gross profit rate is calculated by dividing gross profit by net sales. The gross profit rate for Apple was 39% in 2016, which is nearly equal to that of Samsung at 40%. The similarity between both Apple's and Samsung's gross profit rates can be in relation to how the markets have become more saturated and competitive over time. As the industry becomes more competitive, the gross profit ratio declines. The return on common stockholder equity is a widely used measure of profitability from the common stockholder's viewpoint. Apple's return on common stockholder equity was recorded at 37.92% in 2016, which is about 3 times that of the recorded return on common stockholder equity of Samsung at 12.41%. This comparison shows the difference on how many dollars of net income the company has earned for each dollar invested by the common stockholders.
In conclusion, both Apple and Samsung are both the leading brands in the smartphone industry. Although personal preferences may veer customers one way or another with operating systems, color, feel, and touch of the phones, both companies are very successful. Overall, Apple's liquidity ratios are stronger, with a lower average collection period and days in inventory, but Samsung's solvency ratios are better, with debt-to-assets ratio and times interest earned. The profitability ratios act as a toss-up. Both companies are very close and have very strong ratios. Overall, Samsung and Apple are very close in relation to their success and popularity. Each company faces some issues, like cash on hand, rules change, and recorded revenue. However, they have both consistently been the top competitors. But it should be noted that while Apple's numbers may have been more desirable than Samsung's, they are regressing in progress, whereas Samsung is progressing with their ratios. It can be predicted that these two companies will continue to be neck and neck for a while, until a new wave of technology differentiates the market.